eye-popping surge in repo rate. Rates in overnight market climbed to a level unseen since 2001. Costs in one of the key U.S. borrowing rates surged. Oh, wait, this is Dateline January 2nd, 2019. Sorry, because I was getting worried that the repo rate market would be, oh my goodness, we're all going to die because of repo rates. Seems like we survived. But let's go back to my man at Brian Westbury at First Trust Advisors. Repo madness. This is Dateline. What was this? Just the other day, September 18th. Was it September 18th or September 19th? September 18th. All right. Let's talk about this. In the past few days, stresses in the financial system have shown up. Those stresses have pushed the federal funds rate above the Federal Reserve's desired target range of between 2 and 2.25, and some reports have the funds trading at as high as 9%. The Fed has responded by using repos, repurchase agreements, to put cash into the system and bring down short-term interest rates. The question is, does this signal a systematic problem in the banking system? Our answer, an emphatic no. We believe the stresses are caused by overzealous banking regulation put into place after the crisis of 2008. The most likely culprit being LCR, Liquidity Coverage Ratio. Below is a quote from Jamie Dimon, CEO of JP Morgan, during a panel discussion at Barclays during September 10th financial conference. And I just want to mention, one way to look at the LCR, again, was that the Liquidity Coverage Ratio thing. In this, I'm talking about monetary transmission policy. You see recently China changed the reserve requirement. And when they do that, it frees up $100 billion of lending. You can't do that here because of LCR, liquidity reserve requirements, because it's got nothing to do with monetary policies. It's a conflicting regulatory policy. And LCR also means I can't finance a corporate bond and include it in liquidity anywhere. So when you all, if you are selling corporate bonds one day and you want JP Morgan to take on finance $1 billion project, I can't, because I'll just immediately affect those ratios. The LCR is liquidity coverage requirement. All right, a ratio. So we've taken liquidity out of certain products, and it won't hurt you very much in good times. Watch out when times get bad and people are getting stressed a little bit. The LCR is calculated by bank regulators and determines the amount of cash a bank would need in the event of a severe financial crisis. In other words, banks are forced to hold enough liquid assets to meet cash flow needs under a made-up stress test. These regulator-created stress tests are extraordinary as are their estimates of potential losses. It kind of reminds me of old mark-to-market. So how does this fit today's financial market conditions? With the advent of quantitative easing, the Federal Reserve has put a massive amount of excess reserves in the banking system. However, the Fed has also limited banks' ability to use those reserves through regulation by putting in rules like LCR in place. Stories about what is going on in the repo market are filled with suggestions that the banking system does not have enough reserves. With $1.4 trillion of excess reserves in the U.S. banking system, that simply is not true. Because of those excess reserves, trading in the federal funds market has become very thin. Back in the 90s, daily trading in the federal funds was on the order of 150 to 250 billion per day, and it climbed much higher in the 2000s. On Monday of last week, total trading reserves was just 46 billion. In the past year, trading in federal funds ran a nearly 40-year low. Why? Because banks are forced to hold more reserves than they actually need. QE flooded the system. A spike in the federal funds rate might have signaled a systematic problem pre-2008, but not anymore. So what happened this week? Well, the Fed isn't talking. This is our belief. The Fed cut rates, and low long-term rates increase the demand for mortgages, which reduce cash in banks. Many companies also took advantage of lower rates and issued corporate debt, which some banks likely buy. Oil prices spiked after the drone attack in Saudi Arabia and may have squeezed financial entities who had written contracts protecting their oil clients from changes in prices. Third quarter corporate tax payments reduced deposits at U.S. banks. With such a small amount of federal funds trading, it is highly likely that one or two, or at most a small handful of U.S. banks got caught offsides. We believe this is a short-term problem, not a long one. One way to deal with the temporary issue is to change the overly restrict rules on LCRs and avoid limiting liquidity. That's our preference. It could also just let the market run and teach a small group of banks a lesson. Using repos or adding more QE is a micromanaging the situation. It's not in the long-term best interest of the economy. Excess liquidity and rewarding bad management creates problems down the road. Yeah. But most important, these problems signal that the new path of monetary policy the Fed started in 2008 has grave issues. The Fed should not be as active in managing the economy as it has become. Yeah, absolutely. In the end, we think the market and market pundits have overreacted. No. There are no true liquidity issues in the U.S. other than those caused by misguided regulation. So there you go. And if we just go back, again, eye-popping surge in repo rate, again, is blamed on rules instead of funding stress. And the same thing's happening here. So don't sweat it. Yeah, it is. Rates and overnight market climbed to a level unseen since 2001. All right, we're 9 months into this. The market has done just fine. Does that mean it will continue to do just fine? We don't know. But the idea that all of a sudden, out of nowhere, the repo, oh my goodness, Glenn Beck, that's silly. All right, we'll see you.